All right. Well, welcome everybody. We're going to get started here in just a moment, and we're just getting everybody in here. It looks like, but one of the things I want to just make sure is everyone can hear me. I was actually doing this class once, and about 5 minutes in, I realized no one could hear me, and everyone was trying to chime in on the chat on the right-hand side there. They're sending me emails saying, "Hey, I can't hear you." So I'm just going to make sure that we can that you guys can hear me as everyone's popping in here. But we're going to get started right away. So this is the Retirement 101 class. This is the how-to class of how to achieve a tax-efficient and low-risk retirement plan. And we'll do this rather quickly. I'm not going to make you sit here for too long. But just so you know, some housekeeping items. On the right-hand side there, you should see a spot to send me an email if you want to. Because I'm going to try to get this done in under 45 minutes, I won't have a whole lot of time to try to answer your questions right now, but I will answer them after the class for you. And also you'll see that there will be some things that pop up on the right-hand side, such as the two-page Do It Yourself retirement guide that we'll have for you to download. So there's going to be a bunch of stuff on the right-hand side, so just keep looking at that every now and then. But we'll get started here, okay? So I know some people are just popping in here, but looks like I think you guys can hear me. I've seen a couple of emails come through saying that you can hear me, so we'll get started, all right? So, this is, again, something that I think is opportunity, and opportunity is missed by most people because it is dressed in overalls and looks like work. And so the reason why I believe that there's a lot of opportunity here is there are a lot of things that you can do for your retirement plan and your retirement assets and create some opportunity out of it. Now, a lot of you might not see that right now, but hopefully going through the class, you'll be able to see this. So our objective here tonight is to help you insulate and quarantine your retirement plan by first helping you understand the major risks to your retirement plan during and after coronavirus. And I know we're kind of getting hopefully past that point as far as worrying about it anymore. Then give you 3 simple tools you can use at home and how to implement the retirement kit or the 2-page do-it-yourself guide. And the goal is to really build a tax-efficient and low-risk retirement plan. So we're going to understand where you are right now. Look at your income in retirement, your investments, pensions, Social Security. Look at the current risk and future taxes you might have. Look at the risk versus reward. And the goal is to help you discover the likelihood to retire without running out of money and without having to pay a lot of taxes. And then we're going to find some improvement areas where you can do things on your own, right? Coordinate the income, tax-efficient strategies, investment model that you can implement and believe in. That way you reduce your overall retirement risk and your overall taxes that could actually hurt your retirement plan. And at the end of the class, actually, during the class, I'll actually show you how to be tax efficient with your retirement assets and possibly get all your Social Security tax-free. So a little bit of a nugget there for you to take home with you after this class. I think it's really kind of cool if you actually have up to $64,000 from Social Security. If you're married, you can receive all that tax-free. The key is you got to make it look like your only income, okay? And if you're single, you can have up to $50,000 from Social Security completely tax-free as long as you make it look like your only income. Now, the key part is making it look like your only income source, right? And so some of the things that we'll go over here is how to make things more tax efficient, but also show you how to make things look like it could be, or make Social Security look like it might be your only income source, okay? Plus, we'll learn what the specialists are using and doing during this time to keep calm. And it's not what the talking heads are saying on TV, and it's not losing a lot of money. And my promise here for you today is there's no product sales pitch, no financial jargon. Well, I take that back. Just a little bit of financial jargon. You won't waste your time here tonight. And most importantly, I just want you to be careful of people taking advantage of your emotions during this time. And we're going to do all this in under 45 minutes. We will explain and give you smart ideas to implement on your own. Now, here's why. I understand what it's like being you. At one point, before I was a financial advisor and meeting with people, I was just like you at a point where I was trying to figure out what to do with my finances. But I remember graduating from college, and right away, people were approaching me that some of my best friends, they worked at Northwestern Mutual, Ameriprise, Thrivent, Edward Jones, you name it, right? And they're all coming up to me saying, "Hey, let's get some coffee. I want to talk to you about your finances." And all of a sudden, I'm getting shown life insurance products or mutual funds. And it dawned on me that these aren't financial planners. These are more product salesmen. They're trying to sell me a financial product. And so I became a little bit jaded when it came to financial planning before I became a financial planner. And so I understand what it's like being you. It's very confusing, and sometimes you just want to get the right information and not get taken advantage of. But I also understand what other financial advisors are pitching from behind the scenes, because I used to consult for financial planners. I worked for one of the largest insurance companies called Allianz Life. I would consult for financial advisors as far as what products were best for that particular client of theirs. So I do get to see the good, the bad, and the ugly that's out there. And so I do understand what it's like being you as far as when people are coming after you. I understand what advisors are trying to pitch. And I also understand what it's like being in front of the scenes as a financial planner, sitting down. I'm a certified financial planner. When I sit down in front of people, I understand what they're trying to do, what they're trying to look for. But most of the time, I'm only meeting with people that are in or near retirement. So I understand what you guys are trying to look for. And that's what this class is really revolved around. Okay. So there is a workbook and kit that you can download. On the right-hand side, you'll see that there will be a 2-page do-yourself retirement plan. That way you can cover some of the major obstacles, find out where you might have some potential problems, help you try to calculate your income planning, look at the risk return you might have, and some taxes if that might become an issue for you. Now, the first obstacle that we'll cover is the continued market risk. Now, things are all over the place, things are rather volatile, but we want to make sure that we're looking at the right things. So why you might be focusing on the wrong things when it comes to the markets. We'll look at how the most recent market drop may not be over, how to position yourself so it doesn't significantly impact your retirement plan or have you cash out at a major loss going forward. Why the big financial firms may not care if you lose money in volatile markets. And, really that's just more, sometimes, again, that's more transactional based, right? Then we want to provide a couple simple tools that you can implement designed to help avoid large losses, and then how your withdrawal strategy and passive investment strategy could hinder your retirement plan. The other risk that we have or obstacle is income planning. It can be rather daunting to try to figure out, which asset to draw from first, and why you can't see, feel, taste, or smell inflation before it's too late. And the three big things you'll spend your money on in retirement that have some of the highest inflation. And then we'll also talk about taxes, which we believe is a giant target on our backs. Don't forget the promises we made to ourselves, such as Social Security, Medicare, and Medicaid. And there's also over $28 trillion sitting in some sort of tax-deferred retirement account. Understand how your tax-deferred retirement accounts might have the next biggest target. Okay. We also have to accept the truth that you can't avoid taxes. I know I wish we could avoid taxes, but you can't avoid taxes. However, you can make your retirement and your assets super tax efficient by doing some proper planning. Taxes will go up, and it's not a matter of when. It's a matter of when, not if. They will go up January 1st, 2026, if nothing's done based on how the current tax code is written. And the nation's debt isn't shrinking, and new stimulus isn't going to make the issue any better. So first thing we're going to go through is the continued market risk. We'll talk about the invisible inflation, then taxes, and then at the end here, we're going to go through some case studies, which I find a lot of fun because you're going to find a lot of similarities and probably to what you're doing right now and how to kind of put all those things together, okay? So when it comes to market risk, the thing that we tend to focus on is return first, then we look at risk. But we believe you should focus on risk more than return. But the reason why we don't is because there's typically nothing sexy talking about when we talk about risk, right? We all like the shiny object. We all like to talk about the return. But what's going to make or break your retirement is not going to be the return. It's probably going to be more the risk, right? So when we look at the S&P 500 from 1980 through 2018, you can see the S&P 500 averaged 8.74%. If you were to miss those best returns over that same time frame, you'd only average 4%. If you miss the worst periods over that time frame, you'd almost average 15%. But here's where it gets interesting. If you missed both, I mean, if you missed the worst and you missed the best, you would average almost 10% return. That's better than the S&P 500. So what is this telling you? This is telling you that you don't need to go for the home runs. You don't have to have the big losses, and you can still have a good average return. So if you're just trying to get a good average return, there's no reason for you to take all that risk. We just need to change our mindset a little bit and just go for a good average return. So pick things that are just going to give us a good average return. But the caveat is we have to be willing to give up those home run returns so that we don't have the big losses. Okay. So one of the things we have to make sure that we understand is how much it takes to recover. So even though we might be giving up the home runs, we have to understand that because we are giving up those home runs, we're protecting our assets a little bit more. And that's why we say protect investments above all else. Now, the average retirement account lost over 19% in the first quarter of 2020. Okay, that's quite a bit, which means that you would have to gain 25% roughly just to get back to break even. If you lost 50%, you need over almost 100% just to get back to break even. So losses hurt us more than gains help us. And the average investor is a passive investor, meaning buying and holding. So if you're a passive investor, why are we willing to lose 50% just to get big returns of 50%, but only average 8.74%? Now, we could do better, right, if we go for a better average return, but not have so much risk, okay? So how do we measure risk? Well, there's a lot of ways you can measure risk. In fact, there's a lot of different financial jargon things you can look at. But to be simple here, for a way that you could probably do it yourself, is go look at the 2008 financial crisis. In fact, you could go look at what happened in March of 2022, but it was pretty short-lived. So go understand what you might have lost in 2008. And if your plan can't stomach that loss, then you shouldn't be in that investment or in that portfolio with that much risk. Now, you might have that much risk right now because while you were working, the risk wasn't as much of a factor for you. But now that you retire, or if you're getting close to retirement, you will notice that that will be more detrimental to your retirement plan, okay? So go back to 2008. You can go to, for example, here I went to finance.yahoo.com. I pulled the Fidelity Dividend Growth Fund. You can see it does okay. It had some good returns, but in 2008, it lost 38%. That's a lot, right? And if we put dollar figures in here and not percentages, you would see that it would take quite a while just to get back to break even. So we want to make sure that we look at historical performance to help us understand what the potential risk we might have going forward. And that way we can take the best course of action. Now, besides looking at the 2008 financial crisis, we can also look at something called a standard deviation. Now, standard deviation is a little bit of a financial jargon term here for you, but it's really just measuring the volatility of a fund over time. So if it has a high number, that means that has a high measurement of volatility, big swings, right? If it has a small number, then it's going to have small swings, okay? So if we look at an example here of a standard buy and hold approach, you can see that average return of 6% with a risk of 13, which means you subtract 13, you add 13. So we have a pretty big swing just to average 6%. But if we do a smart tactic and we're just trying to get a good average return, you can do this. You can actually get a good average return so that way you're not going to have the big swings, okay? Looks like my slide wasn't quite updated there, but basically we're just supposed to subtract 5.5% and then add 5.5%. So it's really supposed to say 11% on the plus side and still plus 1 on the other side of it. Okay, so we shrink that down so we don't have those wide swings. Now, who are the best or the world's greatest investors? Well, that's MIT, Columbia, Notre Dame, Yale, Duke. S&P 500 is way out on the right with a lot more risk compared to the others, right? So what are they doing differently? Well, they're not comparing themselves to the S&P 500. What should you do? Not compare yourself to the S&P 500. Because if you do, you're going to be chasing the market and have a lot of those big drops, but not have as good of an average return, okay? So don't forget, markets are never consistent, but that's exactly what we want, which is consistency. If all you want is an average of an 8% return, why not pick things that get a good average with less volatility? Why doesn't this typically work with a 60-40 stock bond mix that we're typically told to do? Well, part of the reason is, there's still a lot of volatility in a standard 60-40 stock bond mix. And if I take a standard 60-40 stock bond mix you see here, we'll see that between 2000 through 2016, the average return with inflation adjusted numbers here, it's a 3.1% return over that 16-year time frame. Okay, our $100,000 grew to $162,000 at the end, but that's a lot of volatility, right? I mean, look how much of a roller coaster that is, going down, then up, then down, then up again, only to average 3.1%. So we have to keep in mind that the same annual returns don't always, if even though we might have a same average return, it's not going to make much of a difference when it comes to if we have a different random order, right? So average return works for you if you're saving your money, but average return is different based on the order of returns when you're taking money out. So to give you an example, I have Mrs. Blue and Mr. Green here. Mrs. Blue is going to start with positive returns. Mr. Green is going to start with negative returns. They're going to have the same average returns. They're both going to take out the same amount of money. But look at the difference. Mr. Green runs out of money early. He runs out of money at age 88, whereas Mrs. Blue still has over $1 million, more than what she started with because of the order of the returns as far as what came in, right? So this matters more when you're retired, does not matter so much while you're working, okay? So there's 3 strategies that you could implement. Strategy number 1, which is the pretty typical strategy, is the standard 60-40 stock bond mix, where money comes out whether the market is up or down. The downfall is here, you're selling from your stock portfolio and you're selling from your income portfolio or your bond mix. You're selling from both, okay? So if we look at an example here, I have John and Jane Smith. They need $70,000 per year. They're in a 60-40 stock bond mix. Over the last 13 years, 14 years, you can see that their $1.1 million continuously draws down to $614,000. Now, the good news is they didn't run out of money. However, they are drawing their money down slowly, but it could come to a point where if they have another big drop, they might lose it all, right? So there is another strategy, which is the multiple bucket strategy. So we want to set up several buckets. And this is a great strategy if you can sit down and really look at it and spend the time on it. But it's also rather daunting because you have a lot of different buckets here. Now, the idea is where you need to take income early on, you want to have a bucket that doesn't have a lot of volatility. It's rather liquid. So in the income years for 1 through 5, then you have a little bit more aggressive portfolio for years 6 through 10, and so on. A little bit more aggressive for years 11 through 15 and 16 through 20 plus, okay? Now, this is a great strategy, and it's great in theory, but people hardly implement it and hardly ever stick to it, okay? So I'm going to give you one other strategy that I think is actually a lot easier to stick with, and it's really simple. You just put 40%, if you're still going to follow the 60-40 stock bond mix, you put 40% in a separate account in the safe side, you put the 60% in the growth side in a separate account, okay? Rather simple. So that way, when you need to draw money out of the portfolio, you're only drawing money out when the market's down out of the safe bucket. And when the market's up, you're only drawing money out of the growth bucket. Okay, so you can see here, I have the S&P 500 fund on the left, a safer bucket on the right. And as the market tanks in 2008 through 2009, I need to allow the portfolio to recover. So I need to draw money out of the safe bucket. And then once I've recovered, I can start drawing money out of the growth bucket again. And then when the market goes down again, you draw money out of the safe bucket. You can see at the end of the day, instead of $600,000, I have $895,000 left over. So I'm not really moving a whole lot there, even though I'm still down a little bit more than what I started with. I haven't moved as much as if you just did a standard 60-40 stock bond mix. Okay, so rather simple strategy that could save you a lot of money and a lot of time. So that's a $270,000 difference. Now, could this strategy work for you? Possibly. Hopefully, it's something that you can look at. Now, apply an investment strategy that has a low volatility. So now, instead of just putting the money in S&P 500, put a smart tactical approach to it. And now, when we have something that's kind of more a managed risk type side of a smart 60-40 stock bond mix on the left-hand side, and we have a safe bucket approach on the right-hand side, you can see we don't have so much volatility. And at the end, we have $1.3 million almost. And now we're ahead instead of behind, okay? So that's over a $500,000 difference, a strategy that can be easily implemented and followed. All right, so let's recap. Make sure to look at risk before reward, understand the volatility and the sequence of those returns, create a bucket strategy to allow your portfolio to recover, utilize tools at your disposal to understand the risk you may have, and then test it, okay? And testing is the key phase there. A lot of times people will come with these ideas and then they never tried testing it. And usually what's worse is most people don't implement it. You want to make sure that you create a strategy and at least implement it. Now we have invisible inflation. So I know we're not doing like a whole lot of travel right now, maybe not a whole lot of entertainment, but we do have quite a bit of healthcare costs still, and that's going to continue to rise, right? So we want to make sure that our money is keeping up with inflation. But the other key part here to inflation, which we don't always consider as part of inflation, is taxes. So we want to build our retirement plan to include inflation, but the thing that may play the biggest role in inflation is yet to come, which is taxes, okay? So let's go into why we think taxes might increase. And part of it's because we have the ever-increasing national debt and the new stimulus, which will put pressure on the system. We have the promises we owe ourselves, like Medicare, Medicaid, Social Security. Then through all this, we'll give you the equation on how you can get your Social Security completely tax-free if you make it look like your only income source. And then the other part is the solution on how to get everything tax efficient, okay? But right now we look at the national debt at the end of 2019, it was at 23 trillion. Now I'm almost too afraid to go look. It hasn't gone down though, that's for sure. When we look at the biggest portion of increasing debt or where our expenditures going, well, with 10,000 baby boomers turning 65 every single day, we're going to have more costs associated with our Medicare and Social Security, right? So how are we going to cover all those expenses? And by 2030, Social Security and Medicare will be over 50% of our total budget, okay? Now, these programs aren't going to go away by anytime soon, right? They're going to still be there. So in order to pay for this, our options are print money, which causes inflation, claim bankruptcy, which is not really an option, reduce benefits, which won't make anyone happy, or increase taxes, which is probably the most likely scenario, although we probably don't like that, okay? But it's probably the most likely scenario. Now, there's $28 trillion that sits in tax-deferred retirement accounts, plus or minus $28 trillion. Now, where do you think that they're going to be looking if we need to get some extra income to pay for all this stuff? Well, that's probably going to maybe be our tax-deferred retirement accounts. But first, let's understand how Social Security is taxable and how we can implement some of these strategies. Because actually, when we look at Social Security, how it's taxable, it might actually change how you might apply for Social Security. It might also change how you start drawing money from your portfolios. Now, the way Social Security is taxable, it's based on your modified adjustable gross income. So take all your income plus 1/2 of your Social Security, then place it in the thresholds below. So if you're single, you'll actually take the equation there. So you take $0 to $25,000 based on the equation that I just talked about. None of your Social Security will be taxable. But if you fall between 25 and 34, then 50% of your Social Security is taxable at whatever tax bracket you're in. And if you have more than $34,000 of income, which is not a lot, then up to 85% of your Social Security is taxable at whatever tax bracket you're in. And you can see if you're married, 0 to 32,000 is 0%, 32 to 44 is 50%, and $44,000 more for income, then 85% of your Social Security is taxable at whatever tax bracket you're in. Now, it also depends on what state you live in, right? If you're in Minnesota, Social Security is taxable. If you live in Florida, your Social Security is not taxable, okay? If you live in Wisconsin, your Social Security is not taxable. However, all I'm talking about here is just federal taxes when it comes to Social Security, okay? So you can get more money from Social Security by creating a more efficient strategy. So one of the things that we see a lot is people will base their strategy on maximizing their Social Security alone without looking at their overall retirement plan, okay? So make sure you create a plan and figure out how your Social Security is going to work within that overall plan. Now, here's why this might be a good idea. Understand what things may come down the road. So for a lot of us, if you have an IRA, 401k, or tax-deferred retirement account, you're going to have required minimum distributions, which start at age 72 if you haven't started them already. The old rule was age 70.5, but that changed recently at the end of 2019. So what you do is you take the December 31st balance of the retirement plan account by the life expectancy factor. So if you're age 72, you take your end of December 1st balance, divide it by the 25.6, and that's how much you have to take out that year. So it's rather simple, although it can be kind of confusing. So I have my dad here. He's 74 years young. He has $100,000 in his IRA as of December 31st, 2019. his distribution factor of 22.9, which means he has to divide by 22.9, is $4,366. So, in 2020, obviously we had the end of 2020 now, so we would, look at the end of the balance at the end of 2020 and see what the numbers are then. Okay. So the story of spending more money because of RMDs and Social Security becoming more taxable. So this is a guy that I worked with. I was teaching a class at a local college, and Joe, he actually came up to me after class and says, "Oh my gosh, I screwed up." I'm like, "Well, what do you mean you screwed up?" He's like, "I didn't figure out, and I did not calculate my taxes. I didn't figure out what would happen when I had my required minimum distribution." He had this nice spreadsheet laid out, but what we failed to do was go all the way up to age 72. So Joe, who was married, worked at the post office, is age 62. He saved $576,000 in his IRA retirement account. Between his Social Security and his pension, it was enough for him to live a comfortable lifestyle. He didn't need to spend the money between his pension and Social Security, but what he failed to do was create a plan to see what would happen at age 72 when he must take his required minimum distribution. Okay, so if we look at Joe's scenario here, he has his pension of $2,300 a month, so $27,600 per year. Social Security of $2,450 a month, $29,400 per year, of which 50% is now taxable based on the equation we talked about earlier. So his total gross income is $27,600 plus the $14,700, which equals $42,300. After the standard deduction, so if he subtracts the $27,400, his total taxable income is $14,900 at the 10% tax bracket. He owes $1,490. So his total net income after tax is $55,500. Not bad. He only had to pay $1,400 or almost $1,500 on that. So pretty good, Joe. But what happens when he has required minimum distributions? Well, let's say that $576,000 that he had saved in his IRA didn't grow at all, and it just stayed level. He still has his pension of $27,600, but remember, he has those required minimum distributions at age 72. So I'll back up just a second. You can see that he has to take out $22,500 that year. You add the $27,600 from the pension. You add the $29,400 from Social Security, of which now 85% of it's taxable, right? So $24,990 is considered taxable based on the equation we talked about earlier because of the required minimum distribution. His gross income is $75,000 after the standard deduction because he's married. He has taxable income of $47,690. Tax bracket is 12%. Total taxes is $5,722, which means his total net income, not including the required minimum distribution, is $51,278, which means he has to take money from his savings to equal the same amount or the net amount of money that he was getting earlier. So he's almost like penalized to save his money. So we need to create some solutions for that, right? Because you might be in the same spot. You might have required minimum distributions that's going to put you over the next level or make your Social Security taxable and so on, which means you're going to have to spend a lot more money of the money that you saved, and maybe you were hopefully not having to spend, okay? So that meant there was $4,232 per year more in taxes, which seems backwards, right? Now, what happens if taxes increase? What then? How is that going to impact Joe, or how might that impact you? Okay, so get out of harm's way now before it's too late. Create a plan that looks at taxes, move taxes based on your agenda. Taxes will increase back to 2017 taxes, January 1st, 2026. Now, I'm not a CPA here. I'm a certified financial planner, but you want to do this and coordinate your retirement plan and make sure you do talk to a tax advisor. See how things might, work in your favor or may not work in your favor here. Okay. So part of the solution is doing a Roth conversion. Now, a Roth conversion is different than a Roth contribution. Roth conversion is where we move money from an IRA or 401k or 403b or some tax deferred retirement account and move it, pay the taxes when we move it. And then after it gets into a Roth IRA, because we converted it to a Roth IRA, we no longer have to pay taxes on it because the growth is tax-free. And if we take any money out, it's tax-free as well. Now, there's a little bit of rules around the gains when we talk about, how long do you have to keep the money in? Really, you have to keep the gains in there more than 5 years or 5 years or longer to make the gains tax-free, okay? So make sure you consult your financial advisor or tax advisor. But Roth conversion is different than a Roth contribution. Okay, when it comes to a Roth conversion, you can do as much as you want. The key part, though, is you got to pay the taxes now when you do it. So if you move it to a Roth IRA, it will grow tax-free, and the distributions afterwards are tax-free as well. So just keep in mind, though, that you want to coordinate everything so it works together. Time is actually your best friend here. So make sure that you coordinate this to work with your overall retirement plan. But the idea is to move the money in the right direction, which is to try to achieve the 0% tax bracket. If we can move everything out of the taxable bucket, taxable would be like your 1099 interest. So savings accounts would have 1099, brokerage accounts, that kind of thing. We want to get out of the tax deferred and move it to a tax free, which would be, Roth IRA. Okay. So strategize now by finding the right path for you. And what the experts are doing during the times like this, and what you could also be doing, is we'll look, making sure you're looking at the risk first, then the return. So writing a risk analysis. And what we use is something called Morningstar and another tool called Quanti. You're using a multiple bucket strategy for income, reposition or rebalance accordingly, adding inflation into the numbers, so accounting for the unexpected, looking at tax opportunities. So look at Roth conversions, which is a great way, a great thing to do, especially when the markets are down. You can still do it when markets are up, and then putting plans together. Look at your current scenario, improved scenario with less risk and more tax opportunity. Okay, this is all things that you could be doing, but most importantly, you want to monitor your plan. And we use a tool called WealthGuard. Some people use many different other tools, so you don't have to use WealthGuard, but you can use RiskLize. I mean, there's so many other ones that are out there, and so you can use even Yahoo Finance if you want to do one on your own. Okay, but use a tool to help monitor your assets. Give us time to make changes before it's too late, and then make sure if you're doing anything as far as monitoring, again, Yahoo Finance is a great, available and free to everyone who wants it. Okay. Most importantly, when you do monitoring, you want to use a tool to monitor your plan and update it monthly. So not just look at your investments. We use different financial planning tools or retirement planning software to help monitor retirement plans. So it's not just updated once, then off you go, right? You want to make sure that your plan is being monitored on a consistent basis. That way you can look at the real numbers, look at market movement, potential fluctuations with current risk and reward that you have, track your income distributions, know what changes you might need to make. So if you're taking too much money out, maybe you need to do a little bit more income portfolios. If you're not taking that much out, maybe you want to look at doing some more passive stuff to help reduce your taxes with your capital gains or something like that. So everyone's unique here that's watching this right now. Everyone's unique. Everyone should have their own retirement plan. Everyone should have their own way to monitor it. Make sure your needs are increasing with inflation. Make sure taxes and the potential future taxes are being accounted for. Okay. And that leads me to the successful retirement plan. So on the right-hand side, you should be able to download your copy to help start and create your successful retirement plan. It's a 2-page do-yourself guide if you want to try to do everything on your own. Now, not a lot of people, like to do this on their own. Some people do. Not a lot of people do, actually. They don't like a lot of people don't really like to do retirement planning or finances or investments as much as we do. So we understand that. But so if you're having a hard time with it, just send me an email, or you'll have an opportunity to set some time up with us later if you want to. But here's what it should look like. Okay, this is what's really important: is understand what your plan looks like currently. Okay, and we want to calculate your income and expenses, the pension and income and Social Security, your money from your 401k, IRA, 403b, look at your risk and reward, and then your taxes. Okay. So when we look at a case study, we're going to look at Bill and Sally. We're going to kind of look at their current scenario. But Bill and Sally want to retire in 6 years. They need $103,000 per year after tax to live a comfortable lifestyle. In retirement, they have about $670,000 in savings. They have Social Security and a pension as well. So, with $103,000 per year might seem a little daunting, but because they have a pension, that kind of helps, right? So some of you may, or some of you might not have a pension. So everyone's different or unique in that scenario. But first, what you do is look at your current risk to reward, right? And so you understand what is the average return that you're getting now, and then look at your current risk. So this is again, we're looking at the portfolio here. It has an okay average return, but for the risk that it's taking, that's quite a bit of risk to get that type of return. Okay. Then we're also looking at the probability of making it through retirement without running out of money. Now, this is a Monte Carlo simulation, which means it's looking at 1,000 different scenarios of getting the same average return, but looking at the volatility of that portfolio and seeing different scenarios as far as what could potentially happen based on that average return and risk that that portfolio has. Okay. Now, 26% chance is not great, but the good news is it's not zero. Okay. So it means that we have enough money saved. We're just taking too much risk with it. Okay. And this is actually quite often what we see. A lot of people haven't quite taken that risk off the table yet because we're so used to just saving and working. But what happens if we kind of do like a DIY model and kind of reduce the risk, but still get a good average return? You can see that's going to significantly improve our plan here, right? We went from 25% to a 79%, almost 80% probability of making it through retirement without running out of money, just by making some small tweaks to Social Security and the investment strategy. Okay, so what is this telling you so far? Well, one, you don't need a lot of risk to make your plan better. In fact, it's the opposite. You take risk off the table to make your plan better. You don't need real high returns, and you just need a good average return with a little volatility. Okay. Now, if you add a smart retirement plan to that portfolio, now what you'll see is my return here is a little bit less, but the risk is significantly lower. And we're going to imply a bucket strategy as well as some tax efficiencies. And so by doing that, now you'll see we have a 99% chance of making it through retirement without running out of money. But what's really cool is if you looked at that 10th percentile scenario this whole time, or that 50th percentile scenario the whole time, you'll notice that with this plan, they're kind of just stabilized and they're kind of growing a little bit slow, but that's just what we want, right? Whereas if we looked at the other scenarios, they were slowly declining, okay? So this is great. This is exactly what we want. We want to help increase the probability of making it through retirement without running out of money. And so at the end of the day, you don't need to make big changes. Small tweaks, a little strategy, and some monitoring could go a long way. So build your success for retirement plan. Start building by downloading the workbook or the 2-page do-it-yourself guide on the right-hand side. And if this isn't something you really like to do on your own, that's okay. We're here to help you. So you can request your complimentary done for you retirement plan in the next 3 days. Okay. And so that way we can actually help you. And the good news is there's no cost, there's no obligation. It's just part of the class here. It's part of the class offering with this class. And what we're going to do is understand where you are now, look at your income in your retirement, look at the current risk and future taxes you might have, look at your risk versus reward, give you what I call the do-it-yourself plan. Coordinate your income, tax efficiency strategies, investment models, so you can go do it yourself if you want to. And then if you're having trouble implementing this on your own, or if you just don't want to do this on your own, you can ask for our help. So that's the good news is you can do all this whole process without a whole lot of confusion, but also you have this opportunity for yourself. Like I said before, opportunity is missed sometimes. So this is an opportunity for you to kind of get your financial affairs in order, see what things look like for you now, see if there's potential any improvements you can make. And then at the end of the day, if you don't want to do this on your own, you can always ask for our help. Okay. So if you want even more help and wants to build your success for retirement plan for this class tonight, you can set up a retirement strategy session. We'll build your success for retirement plan. There's no cost, no obligation. All that I ask is that you gather the necessary information. We'll also send you what you need to gather and just keep your appointment. That's all that I ask. Okay. And what we'll do is, all that I ask again is if you could make your appointment within the next 2 weeks, I would appreciate it. For some of us, we have a cost of the plans. Some of us don't. So if when you're working with one of us here, we're trying to do this complimentary for you. So take us up on the offer if you want to. If you're not a big deal. And then what we'll provide you is your risk analysis from Morningstar, your current plan as it sits, your DIY model plan with some optimized adjustments to Social Security and Roth conversions. We'll do the 401k optimizer, or at least give you a analysis on your current portfolio and potentially what changes to make. We'll look at how much to have in the bucket strategy, so help you look at your growth in your safe bucket. Then you can implement it on your own if you want to. Take it to whoever you know. And then if you want some help, you can always ask us as well. And this will all be conducted virtually or in person. So we'll set up a Zoom call. Typically, our first meeting is virtually. So we'll do a virtual Zoom call. But if you want to do it face-to-face or in person, you're more than welcome to. It's kind of up to you how you feel or how comfortable you are at this point. But we'll do either one based on what you really want to do. Okay? So I want to thank you all for coming. Hopefully, you all stay healthy and safe. I appreciate you taking some time to watch this. But again, we're here to help. If you want our help, we're more than happy to help you kind of build things up for you, give you a DIY plan. And then if you want our help, you can always ask for help afterwards. Okay. So thanks for coming. Hope you all have a great day. We'll see you later.